Yes, hello.
Big man, what's up?
Yeah, good. All right.
Nice, nice. How's the wife?
Yeah, all good.
You sure?
Yeah, yeah, all okay.
Because you said you were going to the hospital the other day.
Sorry.
You said you were going to the hospital the other day.
No, today is Friday, so tomorrow there is appointment. Yeah, I need to visit.
Oh, so she's in the hospital.
No, tomorrow she will be.
Oh, okay.
I'm expecting a baby girl.
Oh, nice,
Yeah,
nice, 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 nice. Wow. So we have to make some forex money.
yeah, I need to.
Okay, okay, okay. All right. So today was NFP, right?
Yes, it was.
Yes, yes, yes. But we don't care, man.
Yeah, as you said, fundamental is not
Yes,
to be
yes.
considered. Yeah.
Um. So yeah, can you remind me of the last thing that we did?
Last class we talked about market turning points and those demand zones and the supply zones where the match orders are filled and the big bank or institution they create an imbalance on the price action chart. So those unfilled orders are filled and create a demand zone on the consolidation. And yes, we will take a risk of 1 is to 3. That is the movement from where the consolidation and the price goes up for a demand zone and retraces back. So you will consider only 1 is to 3 times the opportunity. Then the price when it comes, it called as a fresh zone. Then we talked about limit orders and pending orders. So yeah, then we talked about equilibrium. Yeah,
Equilibrium lines. What did I say about equilibrium lines?
equilibrium line, like it's a flip, demand becomes supply where all the orders are taken by the sellers if it is a demand, and it turns to seller when all the orders are filled. So it becomes a rally base rally.
Okay, so you understand how that happens with order flow.
Yeah, yeah, yeah.
Okay, okay. Um, okay, that's amazing. All right, let's move. We're in a hurry to finish the course.
Yeah, because
Wow.
working on the chart is will make me more deep.
Yes, yes. Don't worry, don't worry, don't worry. You need the knowledge first before you go to the chart. You know, if you don't
Exactly.
get the knowledge, you can't do anything on the chart.
Right, right. Agree.
Don't worry. I've mentored many people all around the world. Most people understand the strategy, can do it. Very simple. Just have to follow rules. Give me 1 minute.
Okay. On the portal, do I have a option to give a feedback or review?
Yes, yes, yes. Yes,
Okay, okay.
yes.
I need to really,
Definitely
I
you
need
do.
to.
Yes, yes. Okay. So let's start. Um, okay, so we spoke about the order flow terminologies, and since you understand everything,
Yeah.
that is good news. So let's move on to the next stage. Now, in the beginner's course, we just understood the mistakes retail traders make. They buy after an uptrend, after a downtrend. Mistake number one. Mistake number two, they buy into supply, they buy into demand. So we need to understand that big banks and institutions, they trade financial markets differently. They buy when prices are cheap and they sell when prices are expensive. What that means is that banks and institutions will sell when they find it expensive. So retail traders have to push the price to make it expensive, maybe by good news or by something funny. So we learn about order flow terminology. Let's look at candlestick charting. Candlestick charting. So this is about a candlestick and how to learn the parts of a candlestick that will show order flow. Very easy. You ready?
Yeah.
Okay, we go. Just a second. Don't know what the hell is wrong with this internet connection. But I don't want to delay time, so Bangladesh.
Yeah.
What lecture number is that?
Is there anyone from India or Pakistan?
Yes, one person from India.
Okay.
It's 1.3, no problem. 1.3. We did the first trading technologies. Candlestick charting.
Yeah, candlestick pattern.
Am I in beginners?
I believe we also finished this beginner before, but I don't know if it is something different.
Oh yes. No, we finished it. This is beginners. I don't know why I didn't give me. Can you see?
Yeah.
Can you see clear or is blur?
Little bit blur, but okay.
Okay, yeah, let's see. Hi, this is Willie J the Trader. Welcome to lecture 1.3.
I'll be discussing forex trading terminologies. In this lecture topic, I'm going to share a few principles about order flow. There are two key things that we need to understand about order flow: the role of the broker and the standard lot. In every market, we need to understand that a buyer needs to be matched with a seller for his transaction to be completed, and a seller needs to be matched to a buyer for his transaction to be completed. Whenever there's a buyer with no seller, that's an incompleted transaction. So on the price chart or in the forex market, every buyer needs a seller and the seller needs a buyer. So the broker will match the buyer to a seller before they can transact or exchange currencies. So the broker is responsible for an order matching process. So at different price levels, there are different buyers and different sellers who have buy orders and sell orders. And the broker will match these orders for their transactions to be completed. Let's look at how to calculate the pip. We need to understand that currency pairs with 5 decimal places, such as the Euro USD, when we are calculating pips, we always ignore the 5th decimal place. So in this example, let's say price appreciated from 1.42760 to 1.42780. We ignore the 5th decimal place and we calculate pips using the 3rd and the 4th decimal place. So this becomes 78 minus 76, and that becomes 2 pips. So in Euro USD, price has appreciated 2 pips. Whenever you have Japanese yen currencies in the currency pair quotation, the calculation of pips changes. Japanese yen pairs are calculated to 3 decimal places. So we ignore the 3rd decimal place and calculate pips using the 1st and the 2nd decimal place. So let's assume price appreciates from 105,134 to 105,234. This is just 23 minus 13 pips, and that is 10 pips. Let's look at the second most important part of order flow, which is the standard lot. We need to understand that whenever we are clicking buy or sell, we are actually doing so in quantities. We are buying the base currency and we are buying various volumes of the base currency. One standard lot represents 100,000 units of the base currency. So when you click on one standard lot, it means you want to buy 100,000 units of the base currency. So let's assume you're in the USD JPY market and you click on one standard lot. It means that you want to buy 100,000 units of the USD. Remember, the 100,000 units of the USD you want to buy is in the possession of someone else. That is a seller. So a seller needs to sell to you for your transaction to be completed. So when you click on one lot size at a certain price, you've only placed 100,000 buy orders. And those 100,000 buy orders need to be matched with 100,000 sell orders for your transaction to be completed. If you do not get a seller to give you all the 100,000 sell orders to match your 100,000 buy orders, then that's an imbalance in the market. There'll be more buy orders than sell orders. So whenever we are trading, we are either buying or selling a fraction of the lot size or a multiplication of the lot size. So buying 5 lot size is simply pushing 500,000 buy orders.
Just a second.
Yeah.
No, just a second, I'm coming. So did I play? I want to understand. Did I play the wrong video? I play forex trading terminologies, but we are on we are on candlestick charting, right?
Yes, we are in the
Look, candlestick charting 1.3.
1.3, yeah.
So we are on candlestick charting.
Okay. Preview.
Yeah, because we did market turning points, we did order flow terminologies. We are now candlestick charting, right?
Yes, yes.
Okay, all right. So, are you ready?
Yeah, yeah.
Sorry, I wasted 4 minutes of your time.
This 4 minutes is not a big deal, but the last 3 hours that you spent, that was really horrible. I am so exhausted.
Really?
Yeah, just 10 minutes before when you knocked me, I was lying on the bed, I was drinking juice, because 3 hours I spent on the PC, like you're gonna knock me and I'm just ready to start. But if you would have said me that you will take more 2 hours, I would relax.
Yes. Sorry about that. Pressure.
Yeah,
You know pressure.
Yeah, I'm taking much pressure. And today
You know pressure right now.
Usually Friday is off here. I wanted to go out, but I told my wife, okay, no, today I have class. Last week I postponed. This week I'm not gonna postpone. I'm waiting for the class because next 2 days will be market off. So you won't be giving me any class.
Yeah, don't worry. You don't worry. We'll do something today. All right, sorry. Let's listen to this. All right.
No problem.
This is Willie J, the trader. Welcome to lecture 1.3. I'm going to be discussing candlestick charting. A candlestick is a type of price chart that displays the high, the low, the close, and the open price of a security over a specific period of time. A 30-minute candlestick will display how price has traded over 30 minutes. It will display the highest price achieved within 30 minutes, the lowest price achieved within 30 minutes, and the open and the closing price of that period. The upper wicks will always indicate higher prices are rejected, and the lower wicks will always indicate that lower prices were rejected. However, the probable area where demand is found for a large time frame momentum bullish candlestick is between the open price and the low price. At GBTA, when we say large time frame, we mean the daily, the weekly, and the monthly time frames. At the open price, demand is greater than supply, and at the low, demand is also greater than supply. So the probable area where demand is found is between the open price and the low price. For bearish momentum candlestick, as indicated at the top right corner of the screen, the probable area where supply is found for a large time frame bearish momentum candlestick is between the open price and the high price. At the open price, supply is greater than demand, and at the high price, supply is also greater than demand. So the probable area where supply is found is between the open and the high price. For you to gain mastery over order flow and predicting market turning points in advance with a high degree of accuracy, using the on-field orders of big banks and institutions, you will need to understand the formation of a momentum candlestick. Now let's look at how momentum candlesticks are actually formed and the parts of a candlestick that are very vital for finding excess on-field buy and sell orders. At the bottom left corner, we can see how price trades in a momentum bullish candlestick. Initially, price drops from the open to the low, and excess on-field orders are responsible for that drop. Remember the law of supply. When supply is greater than demand, price drops. So the movement from the open to the low is because of excess on-field sell orders. price could not go below the low and shoots up back to the open. And this is because of excess unfilled buy orders. When price gets back to the open, there must be an order matching process. And we do not know what is going to happen until after the trading is done. We see price shoots above the open. But for price to shoot above the open, supply must be flipped to demand. It is not possible for price to trade above the open and still have excess unfilled sell orders down here. But you could have excess unfilled buy orders at the open price because that's what creates the trend. At the highest price, supply is greater than demand, so the market drops to close. The equilibrium line or the flip line is always at the open price of a large time frame candlestick. That is the daily, the weekly, and the monthly candlesticks. There is always a flip at the open price. Let's look at the bottom right corner where a bearish momentum candlestick is being formed. At the open price, demand is greater than supply, so price shoots up. So there is excess unfilled buy orders here. When price gets to the high, there's excess unfilled sell orders, so price drops back to the open. Remember, when price comes back to the open, you cannot ignore the fact that there are excess unfilled buy orders here. They need sell orders. Remember, the purpose of the market is to fill orders. There should never be buy orders without sell orders, or sell orders without buy orders. So at the open price, there will be an order matching process. Right after that, we see the market drop to the low. The reason why price drops is that demand has been flipped to supply. And at the lowest price, demand is greater than supply. That's why price shoots back up to the open. So we need to understand that the equilibrium line is very important when we are finding excess unfilled orders, which are obviously demand and supply zones. Remember, the definition of an equilibrium line in an uptrend is a price level below current price where supply is flipped to demand. And the equilibrium line in a downtrend is a price level above current price where demand is flipped to supply.
Azam.
Yeah.
Straight for it.
Sorry?
I'm asking you, is this straight for it?
Yeah, this was same topic, a little bit more deeper with the candlestick definition in understanding the idea equilibrium line. So this was much deeper for the equilibrium line. Yeah, that's good.
Yes. Okay, all right. Okay, so basically we're saying that at the open price of every large time frame candlestick is the equilibrium line. So when I say large time frame candlestick, I'm referring to the daily, the weekly, or the monthly candlestick.
Yeah.
Not the 4 hour, not 1 hour. Only daily, weekly, monthly. Because a bullish candlestick, the lower wick shows that price went down and came back up. What makes price go down? Excess unfilled sell orders.
So when price comes back to the open, it must flip it from supply to demand for it to form a bullish candlestick. You understand?
Yeah.
So whenever you want to trade, you have to make sure that price comes close to the equilibrium line before you can buy. That is the area where you can find serious supply and demand zones. Okay? And in an uptrend, in a downtrend, bearish candlestick, price goes up. The upper wick shows higher prices are rejected. Price shoots up and shoot down. Why does price go up? Buy orders, excess unfilled buy orders. When price comes back to the open, it must flip those buy orders to sell orders to create a bearish candlestick. So whenever price is trading, you need to make sure price comes close to the equilibrium line or at the equilibrium line between. If you want to sell, you make sure that you are selling at prices that are close to the equilibrium line or above the equilibrium line and below the distal line, because for a supply candlestick, that's a bearish candlestick, supply is found between the open and the high. And for a bearish and bullish candlestick, demand is found between the open and the low. Open and the low. So if you want to find these zones, you have to learn about equilibrium lines, which we'll be applying. So let's look. We're about to look at the real footprints of big banks and institutions. When banks and institutions are buying and selling, they create certain footprints on the price chart. They create certain footprints on the price chart, and an astute trader can figure out those levels if he knows what he's looking for. So I told you, big banks and institutions, they move the market with momentum candlesticks. Today it's all about momentum candlesticks. You see this kind of price movement. Yes, this is a bank and institution. Bank and institution movement. You know, bank and institution movement. They move the market perpendicularly. Bank and institution movement. See this kind of price action, you know, this one. That's how you want to see price leave the level. You understand?
Yeah, okay.
All right, so let's look at market structures. Market structures are the footprints. When banks and institutions are playing on the price chart, it looks like certain structures, and you need to make sure that you understand absolutely clearly these market structures. So let's look at for market structures. Hold on. How did I delete this video? So crazy. Okay, so
is it because of net slow or something?
No. Yeah, the internet is slow, but don't worry. I mistakenly deleted a video, but I have it. I have it here, so don't worry. Azam, I hope you are following.
Yes, I do. I'm attending with 100% concentration.
Nice. Oh, okay. Market strategies. So these are the footprints that big banks and institutions, this can show you that, okay, this is a bank buying, okay, this is a bank selling. Bank selling have two structures. Bank buying have two structures. So on the price chart, you have to train your eyes to see these levels. So it is about location and structure. You don't just look at the structure, but the structure must be in the right location. Structure and location. This is Willie J, the trader. Welcome to lecture 1.4. I'll be discussing market structures. In the beginner's course, you learned that big banks and institutions always create major demand and supply levels on a price chart. In this lecture topic, we are going to look at what those demand and supply structures look like. The two demand structures that represent the buying activity of big banks and institutions is the rally-based rally and the drop-based rally. The rally-based rally is a demand structure that happens in the middle of an uptrend. The base represents the order matching process. And remember, to find major demand and supply levels, you need to look for consolidation, that is brief consolidation, and momentum breakout. So these large candlesticks shot price up into a price level where there were excess unfilled sell orders to the left of the base. The base shows us that there was a transaction that happened at this price level. So buy orders and sell orders were being matched till all the sell orders got exhausted and the excess unfilled orders created a demand zone that shot price up. So the rally-based rally happens in the middle of a move. Then the retracement will always happen at a rally-based rally and not a drop-based rally. The second demand structure that represents the buying activity of big banks and institutions is the drop-based rally. It is typically seen as a V shape or a U shape. Banks always will want to buy low, so they placed pending buy orders below current price. Retail traders heard some news and they sold into the pending buy orders of the bank. Because the sell orders are not enough to completely match all the buy orders at this price level, the excess unfilled buy orders shot price back up, creating a drop-based rally. And the reversal will happen at a drop-based rally. And the drop-based rally ensures that you are buying at the extremes of the demand and supply curve. You are buying very cheap because it is preceded by a drop in price. The two supply structures that represent the selling activity of big banks and institutions are the drop-based drop and the rally-based drop. The drop indicates that banks sold into excess unfilled buy orders. The base represents consolidation where buy orders and sell orders were being matched. When the last buy order got exhausted, excess unfilled sell orders shot price down, creating a drop-based drop. A pullback in a downtrend will happen at a drop-based drop because the base represents excess unfilled sell orders. The second supply structure is a rally-based drop. The rally-based drop happens at the extreme of the demand and supply curve because it's preceded by a rally. Big banks and institutions had pending sell orders at this price level. Retail traders got excited by good news and they bought into those levels. There was another matching process after, and the last buy order got filled and excess unfilled sell orders shot price down. So the rally-based drop is seen as an N shape or an A shape. When you want to find out transaction points on a price chart, always look for brief consolidation between 3 to 6 candlesticks and a momentum breakout. Because if Kathy throws a stone and it goes 10 meters and Amy throws a stone and it goes 15 meters, Amy is stronger than Kathy. So candlesticks with large bodies ensure great excess unfilled buy or sell orders.
You enjoy it?
Yeah, it was good. Yeah, nice.
Wow. So what did you learn?
Well, I do have a question in that. Now, what I understood is a continuation pattern of demand curve will have always a demand, rally base rally, and the
Yes.
area is where the consolidation happens. Bank will
Yes.
place more buy orders and take out all the exhausted sell orders. So demand will continue. Now here my question is, when rally base rally happens, let's say we have an entry on a demand zone and we would like to buy again. Do I need to wait a pattern of 1:3 times and the price retraces back to the base to enter again on a
Um.
yeah,
Yes. You see, so you are talking about buying pullbacks.
yes,
When you're buying pullbacks, um, you need to understand that it's not every level that you can buy at, and we only take fresh retracements. You understand? When price comes to the base, we don't take it again the second time because the level is not fresh.
okay.
Yes, so you have to find another level. We don't take price twice.
So in the basing area where base rally is about to happen and imbalances is found, we found 1:3 and the ratio is also good, but the price retraces back to the basing area again where the rally base rally happened. So that
Yes,
time,
that's what I'm saying. That when the rally-based rally happens, the rally shoots price up.
yeah,
So the first retracement to your base will become your entry. But you can't take price coming to the base the second time. It's not a fresh level. That's what I'm saying.
okay, got it, got it.
You know what? You know what? When you have a question, write it down, okay?
Okay, yeah,
Right after the class, you can ask me because you will get to understand everything after the class, okay? Let's look at types of market trends.
oh, sure.
This is Willie J, the trader. Welcome to lecture 1.5, where I'm going to be talking about the two types of market turns. The two types of market turns are reversals and pullbacks, also known as retracements. Before I explain what they are, I would like to say that in every market, price will always oscillate between major demand and supply levels. Buyers need sellers and sellers need buyers for their transactions to always be complete. There should never be a point where there are buy orders with no sell orders or sell orders with no buy orders in any market. The purpose of the market will always be to fill orders. Let's look at the top half of the screen where we could see two structures, a drop-based rally for demand and a rally-based drop structure for supply. Let's look at the drop-based rally, and it is responsible for a reversal of a long-term downtrend that changes direction into a new uptrend. So a new uptrend will always start at a drop-based rally on a larger time frame. Let's look at the rally-based drop, which is also responsible for a reversal for a long-term uptrend that ends at a rally-based drop and a new downtrend starts at the base. A new downtrend will always start at a rally-based drop on a larger time frame. These reversal structures are found on the extremes of the demand and supply curve. And if you remember from our previous lectures, we said the demand and supply curve is simply the price chart. The further you move away from current price, the more imbalanced demand and supply is. At current price, demand and supply is always balanced. So there's hardly a very good trading opportunity at current price. Let's look at the lower bottom of the screen. Let's look at pullbacks. The two pullback structures are rally-based rally for demand and drop-based drop for supply. The rally-based rally structure is responsible for a pullback. This represents unfilled orders, and anytime prices moving upwards and buy orders get exhausted, sellers will take over and push the market down back to a rally-based rally. It doesn't go back down to the beginning of the trend. So you can look at a rally-based rally or a drop-based drop as a filling station or a gas station, where when you are traveling and your fuel gets finished, you just go and refill and continue your journey. So the drop-based drop will always happen in the middle of a downtrend, and a rally-based rally will always happen in the middle of an uptrend. They all represent unfilled orders. Let me just play the summary from the other videos. So you understand, this is a very simple topic. You understood it, right?
Yeah, this cleared my question which I was asking you.
Exactly.
Yeah, reversal
Exactly.
and pullback. Correct. These are two different things.
Bro,
Yeah.
Golden Bridge Trading Academy is the first academy in the world. The first academy in the world, you know?
For demand and supply?
Yes.
Okay. But I heard there is one more online trading academy, but they charge huge.
Yes. I mean, this is the first, mine is the first in Africa, but this is the second in the world. So Online Trading Academy is the first, this is the second.
Wow, nice. Yeah, Tepex service.
No, this one.
No, not this one.
Just a second. I don't know why I'm getting things mixed up. Okay, let me just. Okay, just a second.
It should be okay.
Why do you.
Yeah, 1.6 is missing. Yeah.
Yes, I know. Don't worry. No, we don't. There's no 1.6.
Oh, okay.
There's 1.5 types of market trends.
Yeah.
Okay, 1.5 can't be open because it is from an unidentified event. Okay, I'm coming. Open. The types of Great. The video is 4 minutes. Do you want to watch it again or you're okay?
Oh, no, summary you will do.
Okay. All right, cool.
You will give me a brief idea. Yeah.
So Golden Bridge is an online university for order flow trading. You understand?
Right. Exactly.
Yes. And after we give post mentorship.
Oh, that's great then. Great.
Yes, we're not joking here. All right. So we've done 1, 2, 3. Let's do the last topic for today. Now, the last topic is going to be the steps to finding the GBTA core strategy.
Okay.
The steps you have to follow to find the zones. You understand?
Got it.
And we'll do this just briefly. Then Monday we'll finish the course. Then Tuesday we do final strategy class. Then you graduate into the group. All right. So you need to understand that the two important parts of demand and supply are brief consolidation and a momentum breakout. So you see, let me show you something. NZDJPY. You see this kind of zone? Brief consolidation. Look, 12 minutes. 1, 2, 3, 4. Not this kind of plenty consolidation. No, this is not a zone. Where big banks and institutions are trading, there's brief consolidation. Price don't waste time. Listen, when you have 100 buyers, 20 sellers will get finished quickly. But when you have 180, it will suffer to finish all 80. Now, let's look at the imbalance. 120, imbalance 80. Let's look 180, imbalance 20. So the price levels where demand and supply is very imbalanced, price should trade quickly.
Okay.
When it trades quickly, it must break out with a momentum candlestick. This kind of candlestick, you see, that's a momentum candlestick to show buying force. You're an engineer, I'm an engineer. I'm a mechanical engineer too. That's why I just laughed the day you told me.
Oh, yeah. Great.
Yes, I'm just trading Forex right now, but I'm an engineer. We all know about forces. If Azam throws a stone with 10 newtons and I throw a stone with 15 newtons, my stone will go further in projectile than yours, right?
Yes, that's the velocity acceleration into time. Yeah.
Thank you. Thank you. Yes. So the velocity and acceleration in Forex is on-field orders.
Right.
So the level with crazy on-field orders, price shouldn't waste time and should shoot away very far before coming back to the zone. You see, it shoots very far, more than risk reward 3:1 before coming back. That's what we want to see. I want to take you to NZDJPY, a trade that was caught today. NZDJPY. NZDJPY. Here you go. NZJY.
So you keep switching a different time frame to see the imbalance.
Yes. You don't worry. I'll give you the steps. I'm giving you a strategy. So relax. Yeah. Look at this.
Oh,
Price trade 1, 2, 3, 4. Boom. You see?
yeah.
So excess unfilled orders, drop base drop. This is a drop base drop supply structure. You see? You see price came back to the zone and shot back down.
Wow. Correct.
Yes, so it's about structure and location. That's why I say I'll give you we'll do the structure now.
Sure. Okay. Momentum breakout. Okay.
Yes, but very soon you have your login. Next week I'll give you the login to your student, but you have to register, okay? Okay. Now, to pick the right zones, you must apply a rule-based. You see, one thing about my trading academy is there are rules we follow. If you don't follow the rules, you cannot make money. The rules ensure that you are very disciplined.
Correct.
So the key to low risk, high probability trading is to trade as close to the turn in price as possible. So that if the zone doesn't hold, your loss is kept small. And when it works, you will make 3 times your risk. So we do not take trades that give us less than 3:1 risk reward ratio. So that when we are wrong, we lose 1. When our take profit is hit 3 or more. You understand what I'm saying?
Right.
So mathematically speaking, with Golden Braid Trading Academy core strategy, even if you are wrong 60% of the time, or you are right, you have a win ratio of only 40, you still make money. Because win ratio of 40% means 4/10. That means I win 4, I lose 6. Now, risk reward is 1:3. Risk, when I'm wrong, I lose 6 out of 10. 6 times 1 is 6. But when I gain 3 times 4 out of 10, that's 12. 12 is greater than 6. So even with a risk, so even if I'm doing 4/10, I'll still be making money. You understand?
Got it. Yeah.
So it's a very powerful strategy. Very, very powerful strategy.
That's good. Yeah. Makes sense. Yeah.
Very, very powerful strategy. Okay, just a second. Okay. Now, trade timing. You don't just trade, you have to time your trades in the Forex market. You have to time your trades in the Forex market. So to pick the right zones, we must apply a rule-based process and screen all potential zones with an alt scoring system. You understand?
Yep.
Okay. Timing your entry into the Forex market is very important. A good way to time your trades is to choose a time frame and wait till that period closes before you enter into a position. This is because if you wait for the chosen time frame to close before trading, it will give you an idea of the market sentiment over the last period. So you could choose to either be a buyer or a seller. an example of timing a trade, we'll be choosing a 6-hour time frame and waiting for that period to end to see if it ended period was bullish or bearish, and buying a pullback to demand zones and selling a pullback to supply zones. So if the day doesn't end, how would you know the last 24 hours was bullish? You have to wait for a candlestick to close. So we have a strategy where we trade 1 hour a day, 1 hour a day, 1 hour before market open. We are going to do wonders. That's analysis and stuff for the coming day. Do you understand?
Yes.
Wait, hold on a second.
Okay, okay. Sorry, can you repeat?
One guy just flipped $200 to $1,000
In a day?
in this week.
Oh, this week. Probably he have spotted many setup, or he's following money management, risk management.
Yes.
Then okay.
Look, he just sent me the.
I don't know if $200 to 1,000, he would have
Look.
used his leverage high.
No. It's risk reward ratio. Risk reward ratio.
Step index. So he's using binary. Oh. I don't know about this pair. Yeah, but this pair is not there in my platform. I don't know what are this index volatility, because I see a lot of people on Telegram, they trade on this, but I don't know, my broker have got this index pairs.
Yes. It's easy to make the money if you see. Order flow gives you high risk reward ratio. High. Your risk is high. Your risk is low. Your reward is high, because we are doing 1:3, 1:10, 1:15, and we are taking 2%. So 1:15 is 30% of your account. 3 trades double your account. So it's not a big deal, you know.
Yeah, such volatility, they moves very high. Yeah, that's right. I wonder why and how today session time has crossed 40 minutes and above, and it have never asked you like to join another session, or the session will end in 10 minutes. Yeah, I wonder how. Let it continue then.
Okay, so yes. So what I'm saying is that you have to wait for the time frame to end. So at Golden Bridge Trading Academy, we wait for the time frames to end. We wait for the time frames to end. You understand?
Yeah.
All right. So if the day ends bullish, then we buy a pullback. So this is the strategy at Golden Bridge. If today ends bullish, tomorrow must be bullish. If today ends bearish, tomorrow must be bearish. Provided what stops a bullish rally, which is supply, is way above on a large time frame. And provided what stops a decline or a collapse which is demand, is far below, because your profit margin is the distance between opposing zones. When you want to buy, you want to make sure that there's nothing to stop price going up. So you have to check to see that there's no supply structures. You understand? No supply structures above current price. Okay, so this is the first step at Golden Bridge Trading Academy. We have 2 steps in finding demand and supply zones. 2 steps. 2 steps. 2 steps.
Okay. 2 steps. Determine the trend and mark zone with a distal and proximal line.
Yes. So don't. If you read what is there, you'll be confused. Let me lecture you on it. That what is there doesn't make sense.
Okay.
So now the first step is to determine the trend. You have to write these steps down. You have to write it down. This is not too important. This is the main strategy, so you have to write it down. When you're done with that, let me know.
Sure. Yeah, you can proceed.
You ready?
Yeah, I'm ready.
Okay, we go.
Yeah.
Determine the trend. So under determine the trend, you find alignment. Find alignment. Write that down.
Yeah.
Find alignment between 3 major time frames. The current month, current week, and yesterday. Write that down. When you're done, let me know.
Current month and current week. Sorry, can you repeat?
Current month, current week, and current and yesterday. Current month, current week, and yesterday.
Okay. Yeah, done.
Okay. Okay, so that means that if we are in August and we want to buy, we need to make sure that the August candlestick, we don't use a trend. That's a group of candlesticks. No, we use only one candlestick. Only one candlestick.
Okay.
Okay. So if the current month is bullish, current week is bullish, and yesterday is bullish, we buy a pullback for tomorrow. So that's step 1, determine the alignment. So the first step is to find alignment. We do not trade disaligned pairs. If a pair is not aligned, we cannot trade it. Do you understand the first rule?
Understood. Okay. So current month. Okay.
Current month, current week, yesterday, not current day, yesterday.
Yesterday. Okay. Got it.
Yeah, yes. That's what we mean by alignment. So if the currency is not, if the pair is not aligned, please do not take the trade. Okay. So the 3 time frames must align for us to buy. Now the monthly candlestick doesn't need to be bullish. It doesn't need to be a doji. It must not be a doji. It must be trending. The monthly must be trending, right? Ada?
Okay.
So this is what I mean by alignment. You see, monthly, weekly, day. Monthly, you see, bullish, bullish, bullish for buy, bullish, bullish, bullish for bearish, bearish, bearish for sell. Okay.
Okay.
You understand?
Yeah.
So that's the first step. Now, the second step is find the zone. Find the zone. So now this is how we find the zone. Step 1. Under step 2, there are 7 other steps. So write that down.
Okay. Find the zone.
And under find the zone, there are 7 steps. Step 1.
Yeah.
Mark equilibrium lines at the open price of, so let's say you want to buy. You are supposed to mark equilibrium lines. So for example, let's look at this trade. Let me delete everything from it. Can you see my screen perfect?
Yeah, I can see.
Wow, others are having 2 in a class, 4 in a class, 5 in a class. You are lucky. It's just you one-on-one mentorship for you.
Thanks. Yeah. So for monthly, yeah.
Hold on. I'm trying to look for pairs that are aligned. Alignment means monthly must be bearish, weekly bearish. You see, yesterday bullish. So this will be a reversal, not a pullback. You have to look for month. So the reversal is what we trade in the advanced, the professional level. But for now, you'll be trading pullbacks. So I want to see pairs that are aligned. Okay, no, even we had some aligned pairs yesterday. So let me check those ones.
Well, I got a question here. May I proceed?
Mm-hmm.
Yeah, let's say today
Yes.
is September 4th. So if you go on a time frame of monthly, so the candle will be just forming it, because last 2-3 days the candle won't be showing a bullish nature or a bearish nature. So in this case, I do consider
Exactly.
last month's candle, August.
No, not last month candle. Current. We have certain rules. I'll give you all the rules because there are so many rules. First week of the month, we cannot really trade properly.
Oh
You
yeah.
understand?
Okay, got it.
On Mondays, we cannot trade because I say current month, current week, current day. Monday, the weekly and the daily candlestick is the same. Monday is the same as the weekly candlestick. It's Tuesday that they become 2 different candlesticks. You understand? So we do not trade on Mondays. Meaning that you cannot put a pending order on Sunday for Monday. No, but you can put a pending order on Monday for Tuesday.
Got it. Okay, understood.
Are you okay?
Yeah, I'm okay. Yeah.
Okay. So alignment. US. Let me see USD card. The alignment changed, but let's look at GBP USD.
Because
Perfectly aligned. Perfectly aligned. Look, current month bearish. You must trade below the open. Bearish. You see?
okay, so this is
You see?
running. Yeah.
Current week. This week bearish.
Right.
Yesterday was bearish. Yesterday was bearish. Now, so this is what we do for a sell. We mark 2 equilibrium lines. Remember, I said the equilibrium line is the what?
Opening price.
The flip line, right?
Yeah.
Yes. So open price of the bearish candlestick. So now we are assuming today hadn't happened yet. So step 1, we stay on the D1. Now you cannot use metaphor trader.
Correct. Yeah, we will not have multiple time frames there. Yeah.
Okay. Are you okay with that?
Yes, I agree. Yeah, because we have different time frames.
Okay,
for activity.
cool.
Yeah.
Yes. So you stay on D1 and mark two EQ lines. EQ1, EQ2. So let me remove the line. Let me show you EQ1. EQ1 is marked at the open price, open of yesterday's candlestick, right? You there?
Yeah.
So mark EQ1,
Yes.
open price of yesterday's bearish candlestick. Then you mark EQ2 at the open price of the new day.
Okay.
So in my country, I'm doing this. I'm marking EQ2 at 9 o'clock Ghana time. That's when the market opens. So so you have to set an alarm. Write that down. Set an alarm for the daily open. Set an alarm. You need to set an alarm and label it new day forex market open. So I don't know the time in Bangladesh, but I'm giving you GMT, 9 p.m. GMT. That's when the new market day occurs. Now, when this new market day occurs, you have to mark the second equilibrium line because the first one is already going through. So when the day is about to end, so 1 hour to market close, you need to be doing analysis and finding aligned pairs so that we buy a pullback. You see, because the month is bearish, the whole trend is falling. So anyone buying, I told you upper week shows that higher prices are rejected. So let's go and see where those stupid idiots who are buying in a downtrend, that's the retail traders, they will only buy into supply, right? So let's go find supply inside yesterday.
Okay.
So step 1, step 2. Now, so read what you wrote about step 1 to me.
Yeah, so step 1, we mark equilibrium on the open price. So we have equilibrium 1 and equilibrium 2. And step 2 is set an alarm on the daily open. Yeah, so these are the 2 steps.
You say what?
Yeah, so step 1 is marking the equilibrium on the opening price. And then we plot 2 lines, equilibrium 1 and equilibrium 2. After that, step number 2, we set an alarm. So when the market close, we go back to the chart and start analyzing.
Well, I've not given you step 2. I gave you. Okay, yes. So you mean from the determining the. So give me what we've done so far.
So
what's the first step?
Marking the equilibrium lines. Yeah. Then step 2 is when the market close, you set an alarm.
Not when the market close. You set it before the market close. So the alarm will just go off when the market closes. You understand?
Oh, okay. Got it.
You don't set an alarm when the market is closed. You do it maybe in the morning so that every day, 9 o'clock Ghana time, or any market open, your alarm will blow. Maybe you are with your wife or you are busy. You have to remember market of open. You have to go to your laptop. You understand?
Yes.
Okay. So give me the steps. Give me the steps again. So you just give me the steps, the alignment to what I told you. I want to see that you understand. Then we'll move.
Yes, I understood. So finding the zone in the step 1, we mark the equilibrium point of yesterday's high and yesterday's low, and today we set alarm when the market will open to do the analysis.
Okay. So you say what? Say it again.
Yeah, mark the equilibrium EQ1 and EQ2. And
so how do you mark EQ1? How do you mark EQ2?
Yesterday's opening price and yesterday's closing price. That to align with
yes, you are right. You are right. But please, if you say yesterday's opening price and yesterday's closing price and there's a gap, then that means the opening price of the new day will not be the closing price of the previous day. You understand? So we'll say opening price of new day
opening price of previous day, please. Okay.
Okay, got it. Yes, there can be
Because a gap in the market will bring about a difference.
Okay, opening price of yesterday. Yes, correct.
Okay, so that's step 1, right?
Yeah.
Switch. No, you need Meta 4 trader, Meta 4 trader, Meta 5 trader. Nobody in my academy uses Meta 4 because it will not give you all the time frames. We need all the time frames. We need all the time frames to analyze what we are doing. Do you understand?
Understand. Yeah.
Okay, so now we want to go and look inside, have a very forensic look into yesterday. Please, we are not looking at 2 days, we are not looking at 5 days, we are looking at yesterday. The rule is we use Monday to judge Tuesday, we use Tuesday to judge Wednesday, we use Wednesday to judge Thursday. Just buying pullbacks, that's it. Nobody knows how to trade a reversal till you get to professional. So stick to the rules. Now, switch to a 2-hour time frame. Now watch me. After we've done EQ1, EQ2, switch to a 2-hour time frame. Are you there?
Yeah, I'm noting down. Switch to 2-hour. Okay.
Now, when you switch to a 2-hour time frame, you look left and up, equilibrium line 2. Left and up, equilibrium line 2. Till you find a supply structure, which is a rally-based drop or a drop-based drop. So let's see how this pullback happened. You see, we do this. We move left and up. We look for a strong price drop. But you see, when you get to the 2-hour, you can move from the 2-hour to the 1 minute. But you don't have to stay on the 2-hour because you cannot see inside clearly. So we are looking into this day. Let's move into 1 hour and see if we'll have a better picture for a rally-based drop or a drop-based drop. You see, we can see this picture here. Rally-based drop. You can see?
Yeah.
Okay. So we look at it better. Now you see, we can see this shape. Strong rally base. Strong drop. You see?
Okay.
This drop is not strong. But this drop is, you see the momentum candlestick?
Yeah.
Yes, so step 3, put your proximal line at the open price of the bullish basing candlestick. Bullish basing candlestick before the momentum breakout. And put your proximal, your distal line at the highest price.
Yeah, that's this.
So like this, of the basing. So we want to capture the consolidation or the basing activity. You understand?
Understood, yeah.
Yes. So this zone that we've drawn, but we can now also adjust it like this. This zone that we've drawn represents a supply structure, and it was found inside yesterday. Now, you have to also make sure that it's a strong price movement. When you get a zone, you don't just go and put your money there. We have to now apply all the enhancers. We have to check to screen all bad zones out. So step 3, write step 3 down, proximal line. Proximal line.
Yeah.
Proximal line.
But proximal line, what I see from here, the green basing candle will be the lowest price.
No. It's not the lowest price. The opening price of the bullish basing candlestick. That's what we are using. The opening price of the base. You know? You see? I've marked this at the open price of that base, this green base.
Okay.
You understand?
But will it be not the other base candle, which is, yeah, this one? Not this one?
Yeah, I mean, yeah, you can do it like this. I want to do mine like this. You can do it because when you have this zone and this zone, you just combine both of them. You know what? Let me do the right thing. Let me just put it here, okay?
Yeah.
So this, we want to capture all the consolidation here.
Right.
You see?
Proper base, yeah.
Yeah, so price came into this level. You see the base. Now, so the step 3 is mark proximal line at the open of the bullish base. Bullish basing candlestick.
Correct.
Bullish basing candlestick. And step 4, distal line at the highest price. Now, let's go to step 5. Step 5. Yeah. The reason why I wanted to do this is because of step 5. Step 5 is measure profit margin. Make sure that the lowest point price drop to, which is this, is 3 times the size of the risk. So let's measure the risk. 14 pips.
14 pips. Yeah.
You understand?
Correct.
Price must drop 14 times 3.
52, yeah.
That's about 42 pips. And this is 60 pips, so it qualifies. It has moved more than 1:3 before coming back to the zone. So that when it turns at the zone, we take profit back at this low. You understand what I'm saying? For the initial profit margin. Price can go below the initial profit margin, but this is what we want to see. You understand what I'm saying? Okay, so that's step 5, profit margin. Make sure that it's 3:1, and I'll show you how to do it. Measure risk, measure profit margin. Now, let's go and look at step 6.
Yeah.
When you mark your proximal and distal line, you do not enter the trade at the lines. You enter your trade 2 pips. You measure 2 pips below the distal line, below the proximal line. Nice. This is 2 pips. You enter here because that line is where the bank is buying. If you try to buy there, there's competition with the bank. Your order will not be filled. So fill it 2 pips below the line and put your stop loss 3 pips. 3 pips above the proximal line, above the distal line. Do you understand?
Yeah.
Now, step 7, profit margin. Take your profit here. This is the lowest point price got to before coming back. So you take your profit a little bit before the low, a little bit before the low. You see? Now, what you are doing is that you are risking 2% to make 6% every trade. So imagine having 5.
Take profit a little bit before. That means how many pips?
No. Just it's not in pips. You can use your own mind to see that it shouldn't be exactly at this low. It can be a little bit above the low.
Because
you understand?
Thinking, is it the body I have to look for or the wick?
No. What we are trying to do is that, you see, when price shot out of this level, it went to look for buyers. So this area is where it found buyers because here is where it turned coming back. Okay. So when you are selling, you want to come out before demand because price can bounce on demand. You see how? You see, look at this. You see how it came to bounce on demand before going to the zone. You understand?
Yeah.
So you want to make sure that you take your profit before the demand area. So you can. It's subjective. You can. The more you practice, the more you become good. By a few pips before the low. Do you understand?
Okay.
All right. So that's step 7. So those are the 7 steps for finding the zone. So easy. That's the strategy. Now, that is structure and location in place. Now, you have to make sure that you look for opposing zones. So now when you pick the zone, you see, you're looking at an opposing zone. Price is going to fall down like this. Now, you see, this is another rally-based rally on the daily time frame. So you need to make sure that you come out of your trade before this. Do you understand what I'm saying? Mm-hmm. So you can put your take profit here. Well, this is the opposing zone. You understand?
Okay.
Yes. You need to take a profit before that. You see? So now you've made about 2% for about almost 20%. Almost 20%. About 18, 17% return on one trade. So if you have 2, 3 trades, 4 trades, you can double your account. So you need to practice, bro. Don't be in a hurry to trade. You see, you have to practice the strategy till you understand it perfectly. That's how it works. You have to practice it till you get it right. All right. Okay. So you understand that?
Yeah, the point till number 7 step we are okay, but what you have shown me from daily time frame.
Yes, listen. What I showed you on the 15 minutes is initial profit margin, the first profit margin.
Correct.
You understand what I'm saying?
Yeah.
But I'm saying that when the market is really going to collapse, you don't have to take profit here because the market you might lose on a lot of profit. But I'm saying check for opposing zones on the daily, weekly, and monthly time frames. You understand what I'm saying?
Daily and weekly, but now we are checking on the daily.
Yes, and we found rally-based rally, which is an opposing zone to a sell. So you have to come out of your trade before this rally-based rally.
Rally-based rally. Okay.
So that's an opposing zone. Yeah, that's it. So let's look for one for demand, then we are done. But you see, when you find a zone, you don't just go and trade. We have to do all the enhancers. This is the algorithm. that we use to clear all the bad trades out and focus on only the good trades. We'll do that on Monday. But let's look at one buy example. Do you understand?
Yeah, okay, we will check here.
Bullish Euro AUD. Let me see. Oh my God. Okay, so let me look for the bullish align first. So the bullish example will just be, okay, AUD USD, bearish, perfect example. Okay, who's that? Okay, so let's look at this. Month is what?
Monthly is bearish.
Weekly is what?
Also bearish.
Yesterday is what?
Yesterday also bearish, yeah.
Okay, cool. So let's look at equilibrium line 1, open price, because we want to buy a pullback. Yesterday was bearish, today must be bearish. We can sell today. But you see, there was an opposing zone here we need to come out on. See, this rally-based rally will stop. You see, there's nothing inside this picture to stop price. This stops price from falling. But don't worry. Let's look at how we found the zone. You see? Mark. So you understand step 1, EQ1, EQ2, right?
Yeah.
Switch to 2 hours. Now watch this. Look left and up. For a structure that represents a drop-based drop or a rally-based drop. But you can't see that picture clearly. Now you see this picture, rally-based drop. You see the drop? It's not just about the consolidation. If it's consolidation, then let's look at everything on the price chart. Is this rally-based strong drop that I am focused on? You see?
Yeah, strong.
Yes, so mark your zone like this. You see? Open price, step 3. Bullish base, bullish.
Yeah.
This bullish base, open before the bearish drop. Step 4, the high. Simple. Step 5, profit margin. It moved 3:1. We can see that. It moved 3:1, right?
Yes.
Coming back. When someone catch it, it going back. You see? You see, it's a very powerful strategy. Until you start practicing it, you understand what I'm saying. You get it?
Yeah, this one I understand.
And you just have to be you have to be looking for opposing zones as well, because opposing zones will disrupt the flow of yourself.
Daily, right?
You said?
Opposing zones will check on daily.
No, daily, weekly, monthly. At least daily, weekly, monthly.
Okay.
But the biggest one is the weekly and the monthly. But you can do weekly, monthly first. They can come check daily and see if you can analyze it. Do you understand? Okay. So if I did my analysis, I would have come out from here. You see the risk reward 2% for 10%. This is 10% of your account. If you had $1 million, you would have made $100,000 on only this trade. You understand? Yes, so that's it. So that's another sell example. Follow the rules. Rule 1, alignment. Then the second rule is to follow the 7 other rules. Okay?
Yeah. Any demand
Is it?
Any pair on the demand side, so I can also check.
Yeah, yes, yes. Don't worry. I'll do that for you. I just wanted to show you something. Okay. That's what I'm trying to see.
I wonder like how do I avoid this confusion when start week of the month you won't see a candle forming on a month side when you are in the first, second, or third of the day of a month.
Yes, don't worry, but you still see sentiment. You just need an alignment. The alignment means a confirmation in a certain direction. So don't worry about that.
So
When you are done,
yeah.
is it?
So that time can I look for weekly and daily? That will be okay.
No, 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 no.
Okay.
Please don't twist the strategy.
Okay.
Just stick to what you know.
Because since today is September 4th, so
Bro, I've been doing this for many years, not just 1 week. I've been doing it for many years. So I'm giving you the rules, just follow it. Please.
yeah, okay.
Don't worry about I've been doing this, I've taught many people to do it. Just follow the rules, simple and easy. Okay? Yes, simple and easy, please.
Like what my
I understand your question perfectly, but I'm just telling you that there is alignment when the month is. It depends. If you are looking for a strong price movement, if there is only 3 days and there's been a strong price movement up, monthly, weekly, daily, then that's a full alignment. For temporary alignment, you know.
okay.
So just follow the rules. Just follow the rules. Follow the rules, please. Follow the rules. That's it. Follow the rules. Okay, so let's go to the next. Okay. Price will always move from demand to supply and back again. That's all it is doing. That's all it is doing. Demand to supply, back again. Demand to supply, back again.
Yeah.
That's all it's doing. Okay, so for the demand side, I will just need to show you one that is not on a live chat, but because I can't find a demand alignment. Okay. Okay, so okay, let's look at this.
So with this, the monthly, weekly, and daily time frames were fully aligned. So step 1 is done. Do you understand? Now, step 2 was to mark our daily equilibrium line, EQ1, EQ2. EQ1 is marked at the open price of yesterday. That's this. And the equilibrium line of EQ2 is marked here, the opening price of the new day. Do you get it? Do you understand?
No, can you repeat again? Sorry.
How do you mark equilibrium line? One open price of the bullish candlestick yesterday,
Yes.
right?
Okay.
And you need to have period separators on. Period separators will show you how the period was separated. You understand? You get it?
Oh, yeah, period separator. Yeah, I can. Yeah, I know that. To mark different days. Yeah.
Exactly. So all right, so let's look at that. Equilibrium line 1 is marked at the open price of this. Equilibrium line 2 is marked at here. Equilibrium line is marked at the open price of this time frame. And equilibrium line 2 is marked at the open price of the new day. Do you get it? And that must be done immediately. Listen, immediately the last minute ends and the new day starts. 1 minute into the new day, you mark equilibrium line 2. You understand?
Okay.
Okay, now, EQ1 must be marked open price yesterday, open price today, EQ2. Nice. Now, step 2 is to switch to a 2-hour time frame. Now, when you switch to a 2-hour time frame, I'm saying that do not stay on the 2-hour time frame because it will not be clear. You have to go onto a smaller time frame and check for these patterns. Do you get it?
Okay. Yeah, correct.
Okay. So now, he came to the 15 minutes. So we moved 2 hour, 1 hour, 30 minutes, 12, 15, 12. Then we came and we saw this price movement. Don't go looking for consolidation first. Go looking for a strong price movement like this. You see, this is what represents bank and institution buying and selling. Strong price movement. You see, bank and institution buying and selling. Strong price movement.
Mm-hmm.
You understand what I'm saying?
Yeah, this is a strong movement here.
Now, then we saw the consolidation. You come to the origin, that's a consolidation. You see, it is just below the equilibrium line. So the zones must be close to the daily equilibrium line. The closer the zone, write this down. The closer the zone to the equilibrium line, the better the zone. So some days you might see many equilibrium lines, but you have to choose the one that is closer to the daily equilibrium line. Do you understand?
Yeah, okay.
Okay. So now that we found this, we apply step 3 and 4, that's proximal line, distal line. Step 5, you see we can see that it moved more than 1:3. This is about 1:6, 7, yeah?
Yes.
Then step 6, enter 2 pips above, 3 pips below for stop loss. Then step 7, this is the highest price. Unfavorable buy order should price for higher prices favor the sellers to find sellers to bring back to the zone to fill the excess unfilled buy orders. So we take profit. You see, when you are coming from a buy trade, in a buy trade, your take profit is a sell order. You are buying low to come and sell high. You don't sell to sellers, you sell to a buyer. So you have to sell lower than these zones that we are coming to, opposing zones. This is a clean 1:6, clean 1:5. Do you understand?
Yeah.
Okay, so that's about it. So we are just touching on the strategy a little bit. We'll come on Monday to do order enhances, multiple time frame analysis, risk management. And Tuesday, we do the strategy class again, then we are done. But I might restructure the strategy class because other people will also graduate, so it might be later. But we'll definitely finish the course on Monday. All right, so that's about it. All right, bro. Any questions? If you don't have any questions, I'll move on to my next
session.
Yeah. No, so far nothing. Yeah, it's okay.
Yes, yes. So that's it. So just understand that everything that you need to succeed in forex, I'm telling you, and if you follow the rules, you'll get there. You understand what I'm saying?
Yeah, that is right.
Okay. Okay, bro. Then have a good night.
Yeah, you take care. Have a nice weekend.
All right. Thank you.